Good morning, everyone, and thank you for attending. Today we're going to discuss which tax act is it and the 2021 tax update. In conjunction with the IAA of Staten Island and SCORE Staten Island, I welcome everyone to the presentation. We're going to cover 11 tax acts here, as you see on this slide, all the way back from 2017 to 2021. Slide number 3 shows you how many interpretations, acts, and adjustments have been passed since December 31st, 2020. We had the CARES Act, then going into the Taxpayer Certainty and Disaster Relief Act of 2020 with the Consolidated Appropriations Act of 2021, which is Public Law 116-260. And then, as you know, currently, the Infrastructure Investments and Jobs Act, November 15th, which affected employee retention credits. On slide number 4, we're going to start with the key provisions of the Consolidated Appropriations Act of 2021, signed into law December 27, 2020, and otherwise known as CAA. This law is over 2,000 pages and has up to 32 divisions, so of course we couldn't go into it in an hour and a half, but we are going to cover some of the divisions, Divisions EE and Division N. And as you see, Division N brought in economic aid relief. And you could read that through the link I provide you on this slide. So what is Division EE of the CAA Appropriations Act? Well, it covered certain extenders that were set to expire. So, for example, your medical expense deduction floor is now permanently at 7.5% of adjusted gross income instead of 10% going back and forth. Your education tax benefits have been changed. There was a law repeal on the college tuition deduction for qualified tuition and related expenses, and there's an increase in the income phase-outs now for the lifetime learning credit in marriage with the American Opportunity Credit. We're going to talk about that later. In addition, you have a temporary 100% deduction for expenses paid or incurred for food or beverages provided at restaurants. And remember, that is not prepackaged food. That is served food, and we're going to go over that as well. And then, of course, the CAA had charitable changes that were put into place prior that they now have extended, and you have a standard deduction, charitable deduction for those who are standard and not itemizers on their returns, and that's 9 out of 10 taxpayers, where the increase of the standard charitable deduction went from $300 in 2020 to $600 in 2021, and we'll go over that as well. So what is the Consolidated Appropriations Act, CAA, of 2021? What is Division EE? Well, it researched the Taxpayer Certainty and Disaster Tax Relief Act of 2020, which has tax extenders that now have been extended to 2021. In addition, under Division E, there were changes to earned income tax credit and child tax credit, as well as, we said, the medical expense floor. Also, you had your second economic impact payment, which was $600 for each qualifying individual and for each qualifying children. I provide you on that slide the phase-outs, but remember, this was reconciled already under your 2020 tax return or recovery under the recovery rebate section. To delve a little bit deeper into the 1,200, and it was 2,400 in the case of eligible individuals filing a joint return plus 500 per qualifying child. So the recovery rebate is an advance on the tax credit that will be available when the individuals had filed their 2020 return, and we will see there's a third economic impact payment that affects their 2021 return. Now, many people do not realize that flexible spending accounts, or what is known as FSAs, are not really flexible. But under the CAA, the flexibility was that applied due to the pandemic. Unused balances in FSAs for healthcare and dependent care expenses may be carried over from 2020 to 2021. Remember, you're in the last month of the year, so you have 2.5-month grace period for using these qualified healthcare and medical expense reimbursement. The CAA allowed mid-year changes, and so we're going to see on this next slide what the new flexible spending account relief was. And essentially what they did was, in your plan, if your plan allows it, you can spend down after the 2.5 months, that's usually in place, and then carry over $550. What this arrangement did, the Act significantly loosens the use it or lose it rules that normally apply to healthcare and dependent care expenses, and allowed you to carry over from 2020 to 2021 any unused reimbursements, and then 21 to 22. The thing is, the plan had to be adopted by the employer, and if not, then these new flexible spending account relief could not be applied. So be aware of that. It's the end of December. Look at your flexible spending account relief. Look at your plans and determine how much is in there and whether you need that 2.5 months to spend it down. And also ask about the carryovers. Did they just keep the $550, or did they expand their carryovers into 2021 and 2022? In the CAA, again, the Taxpayer Certainty and Disaster Tax Relief Act of 2020 came into play under Division N. And that law extended many energy-related tax credits through December 31st, 2021. And those are, for example, the non-business energy property credit for alternative fuel vehicle fueling devices, and you can see that here under this slide, 10% credit for qualified non-business energy property, 30B credit for alternative fuel vehicle refueling property, and energy efficient homes credit, as well as a bringback of the mortgage insurance premiums deduction, which is on your mortgage interest statement, Form 1098, that you can see if you're eligible based on IRS thresholds, income thresholds through 2025, and under Section 35 Health Coverage Tax Credit. So what else did the Taxpayer Certainty and Disaster Tax Relief Act do? It increased the maximum adjusted gross income, which you know as AGI, for the lifetime learning credit. As we said, the bill repealed the Section 222 deduction for qualified tuition and related expenses, but it's in its place and increased the phase-out limits on lifetime credit to match the phase-out limits for the American Opportunity Credit effective for tax years beginning after December 31st, 2020. So that's 2021. And the American Opportunity Credit gives you up to $2,500 credit, where the lifetime credit gives you $2,000. And you have to track these. Lifetime can be used once a year. The American Opportunity Credit has to be tracked over a number of years. Again, we said increase of charitable deductions. We'll talk a little bit more about that later on that slide. Mortgage forgiveness debt relief in the middle of the slide. So that was changed from excluded income under Section 108A1B. It was lowered from $2 million to $750,000, which will apply to 2025. In addition, this year, you should be scurrying and also meeting with your clients to remind them that they have to pay back the deferred payroll taxes that they deferred in tax year 2020. If they're self-employed, we're going to see later on a slide that they could do that also through the voucher that's provided by the IRS and pay 50% before December 31st, 2021 and 50% after before December 31st, 2022, but after the new year. There are certain employees and federal employees, members of the military, and other taxpayers may pay back the deferred amount of payroll taxes through the entire year of 2021. And there's an exclusion for those volunteer firefighters and emergency medical responders. The bill makes permanent Section 1398 gross income exclusion of certain benefits provided to volunteer firefighters and emergency medical responders. Second bullet from the end of this slide, I think, is very important to the construction workers and the construction industry and building and trade workers. The age for retirement was lowered to 55. All right, here's a large slide on the charitable contribution changes. They are more generous limits these days. We know in the CARES Act in 2020, it has been extended into 2021, that standard charitable deduction for cash contributions. So you must receive an acknowledgement letter or have a canceled check and acknowledgement letter from the qualified charity, which you would find under search of publication 78. And so $300 is for your singles in 2021 up to that amount, and $600 in the case of a joint return. Now remember, these contributions, these rules, do not apply to contributions made to certain public charities, including supporting organizations and donor-advised funds. Also, under the legislation, there was a permanency of presidentially declared disaster zones. Now, not that their zones have been locked in, but that if there is a casualty, be it a hurricane, like for example, Hurricane Ida, now there are all types of legislation with regards to retirement relief, of course, up to $100,000 for a qualified disaster distribution, which is known as a QDD. This does not necessarily get attached to COVID-19. That's separate legislation, but this was now made permanent that the IRS has the ability to extend filing deadlines, certain filing deadlines, if there is a qualified disaster. Now, just remember, when you have a qualified disaster, you want to be aware that if you're going to take a casualty loss, which of course was taken out from the Tax Cuts and Jobs Act of 2017 personally, you are permitted to go back to the prior return. So say, for example, in 2020, there was a qualifying disaster event with a presidentially declared disaster zone, you were allowed to go back to 2019, okay? And that is still in place for 2021. The COVID relief distribution that we'll talk in a few minutes, that expired in the end of December in 2020. But there were certain retirement withdrawals, including a hardship withdrawal, which is usually done in service, from 401ks and 403b arrangements, and can be recontributed no later than June 25th of 2021. Now that is passed and you can't do anything about that right now. There are certain provisions that allow you to have reasonable cause. It's outside the scope here. But we wanted you to be aware that there is permanent qualified disaster distribution relief under COVID-19 and also under other types of disasters. So I mentioned coronavirus-related distributions, and under the CAA, it provided retroactive adoption of the CARES Act. That's where the coronavirus-related distribution occurred, under the CARES Act of 2020, which was signed into law about 14 days after the shutdown. So you're talking March 27, 2020. You can do an in-service distribution from a money purchase plan in addition to your other retirement plans if you qualify under the CRD distribution rules. In June of 2020, the IRS published Notice 2020-50, which is guidance for coronavirus-related distributions and loans from retirement plans under the CARES Act of 2020. And in that notice, it took the position that because the CRD was not a new form of in-service distribution, it was not possible to take a CRD from a money purchase pension plan unless the plan permitted an in-service distribution, generally not before age 59 and a half. So the CAA, to help the taxpayers and the employers, modified that position, the IRS position, and provided clarification that a money purchase plan or pension plan can have an in-service coronavirus-related distribution and does not have a tax qualification problem. And now we know with the coronavirus-related distributions, we were permitted in 2020 to first determine if they qualified, and then up to $100,000, they were able to make sort of like an installment over time, 2021, 2022, and 2023, where they report a third of that distribution. We'll talk about that in another slide. The other problem that the IRS saw is that when you have the pandemic, you possibly have a partial plan termination. And so they made plan termination relief, that employers can update their plan documents and not fall into that unsuspected planned termination. The CAA, again, signed at the end of December in 2020 to affect 2021, included a relief provision that allows a plan to avoid partial termination with respect to any plan year that includes the period beginning March 13, 2020 and ending March 31st, 2021. And if the number of active participants at the end of that period is at least 80% of the number of active participants at the beginning of the period, then you won't have a plan termination. Now, if you use the relief, or the employer uses the relief under this act, it works best with respect to a plan that has not yet determined that vesting must be accelerated as a result of partial termination. And it's provided that the statute, such as whether accelerated vesting can be undone on a prospective basis, is not totally clear. So you have to watch out for partial terminations with regards to the pandemic if you are an employer or a practitioner that's helping an employer. Now, we know that we were concerned as practitioners and as small businesses and individual taxpayers that some of this COVID relief is taxable. There is no tax on the other forms of COVID-19 related federal assistance. So in addition to resolving tax issues relating to PPP loan forgiveness, the CAA also provides that gross income does not include what? The PPP, if it's forgiven. Of course, this does not talk about what you're supposed to record on your financial statements, but it talks about tax. The PPP loan forgiveness is not taxable, and the EIDL, or what is known as economic injury disaster loans, and emergency financial aid grants, such as the Restaurant Revitalization Fund and Small Business Bankruptcy Reorganization Act. In those acts, these pandemic payments are not included as taxable and not included for gross receipts purposes. Now, of course, you have state and local issues, and you should look at those separately. We're going to have Brian Gordon later on this presentation, and he's going to do residency and telecommuting issues. So what other important changes are there? I had mentioned educational assistance. They focused on this with the students, and the CARES Act included a temporary change that allowed employees to avoid tax on student loan repayments. And that went from March 27, 2020, when the CARES Act was put in place, to December 31st, 2020, with respect to qualified education loans. And so, if your employer wanted to, of course, they can provide you up to $5,250 tax-free. This is an annual limit, which is not indexed for inflation, and so would take into account other amounts that might be excluded under this provision. But the CAA extended this to 2025, so your employer could help you with your student loans or your current tuition without being taxed up to the IRC Section 127 limit of $5,250. And then the American Rescue Plan extended student loan forgiveness to January 31st, 2022. Okay, in addition, we had the Families First Coronavirus Response Act. That was the second page that I showed you on all those acts that changed from 2020 to 2021. And it introduced an Emergency Family and Medical Leave Act benefit, EFLMA, and a new Emergency Paid Sick Leave Act benefit, PSLA. I give you a citation from a law firm who did an analysis of it, and I give you a link for an alert. Each was paid through federal tax credits, and each was scheduled to expire at the end of 20, but the CAA, the Appropriations Act, expanded it to March 31st, 2021. So what is the Employer Paid Family Medical Leave Act subsidy? In addition to that EFLMA that we spoke about above, Emergency Family and Medical Leave Act benefit, and the PLSAA benefit, which is your Paid Sick Leave Act benefit, the Internal Revenue Code made it available those since 2018, where an employer could credit to assist the cost of providing paid leave. So the employer credit to assist with the cost of providing paid leave. Eligible employers are able to claim a credit, and they're equal to 12.5% of the eligible wages. What you need to do on the maximum FMLA leave supported by the credit is 12 weeks per year end and is available only for employees paid less than a certain amount in the preceding year. So for example, for 2021, you use 2020's wages and you see $78,000 paid in 2020. So you could use those to determine what your paid FMLA subsidy is for your plan. And of course, the employer always has to have an adoption written in their leave policy for anything that changes going forward, and as we said in our retirement plan. The provision which is available whether or not the employer is subject to FMLA was originally due to expire at the end of 2019, extended through the end of 2020, and then the CAA extended through 2025, and you can find more information at irs.gov. I provide you that link. So this slide just gives you the summary of some of the things I talked about with regards to sick and family leave credits. There's a removal of mandatory provision that employers pay for no work performed, meaning they can include healthcare and retirement plan contributions, even though the employer wasn't working at that time. An extension of employer credits on Form 941 through March 31st, 2021. And note, the American Rescue Plan Act, which was then later signed into law by President Biden, extends those through September 30th, 2021. Adjustments to provision of the self-employed for income back to 2019 instead of 2020, as if in the FFCRA, and then the American Rescue Plan of 2021 also gives continuous assistance to the unemployed up to September 6, 2021. However, we know certain states let it out earlier. So we're going to do keywords, and I'm going to say a poll question so you can have the time to think about the keyword and write it down. The poll question is not part of your CPE or CE credit on this because we're not doing tracking of the poll questions, but I want you to put it into the chat so you're interactive with this presentation. So poll question number 1, can someone claim a tax credit for sick and family leave wages paid in August of 2021? Yes or no? Can someone claim a tax credit for sick and family leave wages paid in August 2021? Yes or no? Put that into the chat. Okay, the key word that we're going to have for today is American. American is the key word. Okay, other expansions of paid and family leave. There was an expansion, as we said, for the paid and family leave for sick pay, and the eligible wages were up to $12,000, and also self-employeds could take the credit. Well, the American Rescue Plan Act of 2021, signed in March of 2021, had modifications to the employer-paid sick and leave credits to apply to the qualified sick and family leave credits for self-employed individuals. The American Rescue Plan also provided COBRA, continuation coverage, and premium assistance for files. So I had a client who was terminated in August of 2021. They elected to go on COBRA because their health insurance plan ended August 31st, 2021. And then September and October were covered under the premium assistance, so they didn't have to make payment, and their payment started November 1st of 2021. So that's what's actually being described here. IRS updated the employer tax returns Form 7200, which is your advance payment employer credits due to COVID-19, and Form 7202, credits for sick leave and family leave for certain self-employed individuals for tax year 2021. Now think about this. Can someone claim a tax credit for sick and family leave wages paid in August of 2021? Yes or no? Put it in the chat. Well, the answer is yes, they can. They can claim a tax credit for sick and family leave wages paid in August of 2021. So let's look at some of the business tax provisions and business disaster tax relief. Special rules for the use of your retirement funds in the business has been put in place special casualty loss rules, and of course, the employee retention credit. So generally, when I look at Section 179 and bonus depreciation, I take into account which state we're in. So for example, in New York State, there's an add back for bonus depreciation, but not for Section 179. In New Jersey, there's a limit on how much Section 179 you take. So you have to, as a client, as a taxpayer, have to ask your practitioner, and the practitioners must know these rules to determine which they should take. In addition, luxury autos in the Tax Cuts and Jobs Act to help the auto industry are still in place. And so you have, before December 31st, to put in place what's noted as a luxury auto. However, the TCJA greatly increased that limit because prior to the GCTA, you can only put into place and have a first-year depreciation of $3,160. That act increased for vehicles with gross vehicle weight rating of 6,000 pounds or less, the maximum first-year deduction for 100% business use of $18,200, and that includes $8,000 for the first-year bonus depreciation. So you have already an idea of what you want to do with regards to lowering your income before December 31st. But keep in mind, the business use percent must be applied to that amount. If you're not using it 100%, which you should be for your business, segregated out from other personal vehicles, you can get up to 100% of that amount, $18,200, as a current year deduction before December 31st, 2021. Now, as we know under the Tax Cuts and Jobs Act, maybe not all of us know, but many of us know, that the category of listed property, computers and peripheral equipment, was removed from the listed property category. And what that did was, when you are now at the end of the year and you need to buy a new computer or other electronic device, such as laptops, tablets, and printers for business use, you don't need to do an inventory of those items and use of those items as a listed property. They can be first year expensed, not as an asset, but expensed right on the front of the tax return as a other deduction. Keep in mind though, equipment inventorying is still required for cybersecurity purposes, and many of you know how I do a presentation on how to prepare a written security plan for your business and for your tax practice. That inventory is still required with your written security plan. Okay, so let's go to the next slide, and we're going to talk about the Work Opportunity Tax Credit, which is known as WOTC, under IRC Section 51, which contains the statutory language. Now, this came out of the Taxpayer Certainty and Disaster Relief Act, as we said, of 2020, and it was supposed to expire as of 2021, but it's been extended to 2025. And generally what you do is you calculate and claim the credit on Form 5884, Work Opportunity Credit, and it's subject to certain limitation rules, which will flow through to Form 3800, depending on what other general business credits you have. Again, outside the scope, but I wanted you to be aware of it, there is a higher limit of $12,000 for the first year wages paid to a qualified veteran who's entitled to compensation for a service-connected disability and who was discharged or released from the military within the last year. And what does that translate into? A maximum credit of $4,800 per eligible employee, 40% times $12,000, as I said, for you to deduct. The other credit, which is lower for other targeted areas, and who are these workers or hirees? There's a long list. You could find it at irs.gov. I provided you some here. These are qualified ex-felons, designated community residents, vocational rehab referrals, qualified summer youth employees, which we have that in summer programs, and qualified SSI recipients, long-term care assistance recipients, and of course, your qualified long-term unemployment recipients. So don't forget that credit. It's very usable, and you could reduce your taxes by hiring those specific groups of employees. Now, the other provisions of the pandemic acts under the CARES Act, You know, we had the pandemic unemployment insurance. As we proceeded into 2021, under the American Rescue Plan, benefits were extended from 39 to 50 weeks and were set to expire on April 2021 until extended by the American Rescue Plan Act. Also in 2020, the first $10,200 of unemployment was federally non-taxable. Again, it doesn't apply to your state, like New York taxes it, added it back. New Jersey does not. And that was in 2020. Millions of returns are still being processed for this tax law change, and that will be effective before December 31st, 2021, we hope. There was expanded relief for renters. The Act provided $25 billion for rental assistance during the pandemic, and it included both past and future rent and utility payments, and extends the eviction moratorium through January 31st, 2021. And if you remember, the New York State Supreme Court made an interim ruling in 2021 on a stay of this. And we saw an expansion of the Paycheck Protection Program, and I talked about the EIDL, and there was a second draw with that Paycheck Protection Program. So as we're going into SBA issues, September 10th, 2021 is very important. The SBA modified COVID-19 small business disaster loans to support the hardest hit businesses, and I give you an excerpt from one of the attorneys here. On September 8, 2021, the SBA published a new interim final rulemaking. As you remember that second slide, there's a lot of those. It's called IFRs, that expanded the COVID-19 Economic Injury Disaster Loan EIDL program, effective immediately through December 31st, 2021, or until those funds ran out. Now remember, in the EIDL program, you must prove substantial economic injury. The first thing as accountants, which we should be doing, and small businesses, is we look at our current assets minus our current liabilities. And if we have a negative, that means we have a negative working capital, right? So that we can prove that we are harmed and resulting in the inability of a small business to, 1, meet its obligations as they mature, and 2, pay its ordinary and necessary operating expenses, and 3, market, produce, or provide a product or service that we ordinarily, not a new service, previous service that we ordinarily marketed, produced, and provided by the business concern. Okay, so you need to prove that to an SBA case manager. Substantial economic injury. Now, in both these cases, you need to keep your documentation for 6 years. 6 years from the PPP loan forgiveness and 6 years from the date that you received those EIDL funds. Okay? And what I'm telling you is that you need to use the funds specifically for what the funds are supposed to be used for. Remember, COVID-19 EIDL is not required to assume a primary position if a borrower has existing debt. Unlike PPP loans, a COVID-19 EIDL is not forgivable. A business can receive both a PPP loan and a COVID-19 EIDL as long as the funds are not used for the same purposes. Now, this slide just lets you know that the SBA modified their COVID-19 small business disaster loans to support a large span of businesses. And as this slide is showing you, under the NAICS codes, which are national codes for businesses. Codes are very important now, so you've got to watch those codes on your returns. Goes from educational services, arts and entertainment, of course, accommodation for food and services, all the way down to sporting goods and transportation, motion picture industry, broadcasting, rental and leasing services, and personal and laundry services were expanded to this list as substantially affected businesses. The SBA applications, of course, must have been received on the second drawer for PPP through the banks before December 31st, 2021, and through the EIDLs for that loan. Also with an SBA certificate from the business. So for example, that officer now has to certify who the officer is and personally guarantee the loan. Of course, an EIDL loan stays with you and your business for 30 years. So you may want to prepay it. You can. There's no prepayment penalty. But you need to be aware of that it only covers working capital, as I said, current assets minus current liabilities, payroll, rent, and maintenance, normal operating expenses, prepayment of any business debt due, and that's a new one that was added to that list, and the principal and interest payments toward federal debt. And remember, many of these had to be in place prior to that date, February 19, 2020. Okay, slide 31 now shows us the American Rescue Plan, or what is known as ARPA, of 2021, and that was passed in March of 2021. And enhanced credits. Which credits did it enhance? It enhanced the child tax credit, which is known as CTC. It enhanced the child and dependent care credit, the earned income tax credit, the premium tax credit that we touched upon before, and now we have recovery rebate credits on our returns. We had it for 2020 to reconcile the economic impact payment number 1 and number 2, and then we're going to have a recovery rebate credit for economic impact payment number 3, which the maximum amount was $1,400, and that came out of the American Rescue Plan. For those that were eligible to receive, they can claim the difference as a recovery rebate credit on their 21 tax returns, and as we know, we had to have the notice that the client received, a 14-4C, to know what amount of the credit is. Now, IRS on their portals don't leave that on there because they're constantly providing tools for people to get relief, and so you cannot find out what that person received. They have to go back to their books and records and let you know, or provide you the 1444C form that they should receive in January, or they might have received it previously. So here is the child tax credit. It extends the qualifying child to under age 18 as opposed to age 17. The credit increases to $3,000 per child from $2,000, or $3,600 for under age 6. And what you need to be aware of is the provisions that were in place for the first $2,000 are from the previous tax laws. The addition is the extra $1,000 that you received for children that are over the age of 6, and an additional $1,600 for under the age of 6. And of course, there's new phase-out amounts for the additional credits. And in 2021, they're going to be refundable, which means that even if you don't have the tax, you're going to get a refund on the credit. However, if the taxpayer who received more in advance payments than they are eligible for in 2021 will generally have to repay some or all of the overpayment. So I have an example, and this may affect you as well, of a divorced couple. And in 2020, the husband took the dependent and then received the child tax credit. So when the American Rescue Plan was passed, he started receiving advance payments in July, and that's going all the way to December. Now, as this went along, you were allowed to go to a portal and update your information and let them know, I want to stop these payments. Because in the next year, for that particular individual, the ex-spouse is going to take the dependent for 2021, and thus he will owe back the money that he received. Now, the Build Back Better bill is trying to remove that, but right now that's where it is in place. In addition, when we were in the middle of 2020 returns in the 21 tax season, I had to determine what returns had to go on extension so that the client would be eligible for the advanced child tax credit that they're receiving monthly. However, when they come into play in 2021, after filing the return on October 15th extension, their income may be higher, and that means they may owe some of the money back. But it was to provide you funds ahead of time. So there's going to be a reconciliation, and there's going to be a lot of returns that are going to take longer to process. IRS promises not that it won't take as long. There should be a 21 turnaround, but I'm expecting delays. And you need to tell your clients that. Now, the child and dependent care credit on slide 33 or page 33 of your handout, this was significantly increased. The dollar limit amount increased to $8,000 instead of $3,000 for one qualifying child, and $16,000 for 2 or more. Remember, it was a maximum of $6,000. Now, generally, you can't go up to the age of 13, over the age of 13 and over, but the child must have a disability for you to do so. The amount of the credit has been increased to 50% of employment-related expenses, and dollar limit and qualifying expenses have been increased, as I said, from $8,000 for one child and $16,000 for 2 or more children. That increase is fully phased out when the AGI reaches $438,000. And so there's a pretty significant income that you will be giving these percentage of these credits, okay? Increased credit rate and income phase-out amounts, refundable in 2021 for most taxpayers, meaning if they don't have the tax. And of course, a percentage is applied to that 50% number instead of the 20% number that we had previously. Also, the taxpayer, the employee, can be provided dependent care benefits up to $10,500 or $5,250 for married filing separately or singles and others. So here's poll question number 2. And again, remember, this is not a poll question to determine whether you're there or not. It's critical thinking for you to understand what we just talked about. So put your answer in the chat, and we can take a look to see how you're interacting, and then I'll give you a keyword. Can a taxpayer opt out of the advance payments of the child tax credit? Yes or no? Can a taxpayer opt out of the advance payments of the child tax credit? Yes or no? And the key word in this case is advance. The key word in this slide is advance. So jot that down because you'll need that to enter on your surveys to get your CE and CPE credit. And so the answer to this question is yes. IRS has had a portal since July when they started implementing the advanced child tax credit payments, and you can update your income so that you may not have to pay it back when you file your 2021 return. All right, what changes have occurred for the earned income tax credit? So you have an expansion for taxpayers with no qualifying children, then and the investment income increased with the earned income tax credit, because immediately when you went over $2,500, you were denied that you weren't able to take the credit. The American Rescue Plan made several significant enhancements to the earned income tax credit with regards to age and when you can actually, what income you could use to claim the credit. So for 2021 and 2020, you would be using 2019 earned income, okay? And that's to help you can opt to use that. Overall, though, it made the credit more widely available for broadening age groups. And what is that? So for filers claiming the credit without a qualifying child, the minimum age can claim the credit was lowered to age 19. For former foster youth or qualified homeless youth to a minimum age was reduced to age 18, and then the maximum age no longer applies. So you no longer need to be under age 65. Okay, so you could be older than that and get an earned income credit without a child. So what do we do if we were denied a credit? I had a case where you go through that prepare a due diligence checklist for these credits, and you ask the questions to the client, have they been previously denied? And they say, no, I don't remember, I haven't been denied. So we check that no, and we try to file the return for the earned income credit. And it came back as no, this taxpayer is not permitted to take the earned income tax credit. So what do you do if it was past the 10-year period, okay? If it was for neglect and not for a mathematical error, negligence rather, there could either be a 2 to 10-year period. In this case, it was a 10-year period that the taxpayer never needed to use the earned income tax credit, and so the system denied them. And what you need to do is attach to the form and the return 8862, information to claim certain credits after disallowance with your next tax return, okay? And that must be attached to the tax return. But you do not have to include it with the tax return if you've previously filed this form 8862 and you're claiming the credit without a qualifying child on the return. Now, if you received a CP74 notice from the IRS saying that you were recertified, you don't need to attach the 8862. You can attach that and ban, and yet you were previously banned from the earned income tax credit, but now you're not. So there is a provision for you to work this out. If you can't claim the credits again for several years, it's because of reckless or intentional disregard of the rules. That's for 2 years, and then 10 years if it's outright fraud, okay? Outright fraud. And you know, IRS has civil fraud penalties, and this is like a civil fraud penalty in this case. And I provided you a link that you could go out to find more, but I just wanted you to be aware that if there is a denial, you have that opportunity to apply Form 8862 if the taxpayer is qualified. Now, we mentioned in the case that I talked about where the employee was terminated in August of 2021 and then was able to get COBRA and have premium assistance in September and October of 2021. And the reason, because of that, it eliminated the household income provision that may not exceed the 400% of the federal poverty level in tax years 21 and 22. What does that mean? So I'll give you an example. For a household of 3 with an income of $87,840 is what would be the 400% poverty level up to that amount. But now you can go over that and still get premium assistance. All right? And those were special rules for 2021 and 2022 during the pandemic, and that affected Form Change 8962 premium tax credit, which should be corrected by now because we had that during tax season. So the key word on this slide is rescue. Rescue. Okay, so jot that down. That's what you're going to need for your surveys. All right, what other employment tax changes do we have? We had the extension and modification of the employee retention credit. And that brought us our new Form 7200, which is an advance of those credits. Now, the American Rescue Plan Act extended the employee retention credit through December 31st, 2021, and you have to do an analysis of your gross receipts and whether you were affected by any stop orders. Let's go through some of the specifics. So we're talking about this employee retention credit that was passed in 2020 for 2020 and had certain provisions, and then was changed in 2021 by the CAA at the end of December, by the Appropriations Act at the end of December. So what are the differences between 2020 employee retention credit under the CARES Act and 2021 employee retention credit under modifications of the Appropriations Act? Well, in 2020, under the CARES Act, those who had PPP loans were excluded. However, in 2021, under the Appropriations Act, they were available to those now with PPP loans. So you were able to apply for the employee retention credit. That was changed. Qualified wages paid after March 12th of 2020, so it was retroactive back to 2020. However, payroll cost under the employee retention credit reduced your PPP payroll cost for loan forgiveness, okay? Then when we look at what the actual credit is calculated in 2020 based on 50% of the qualifying wages capped at $10,000 for the 2020 calendar year. But under the Appropriations Act, the credit calculation was based on 70%, so it increased by 20% of qualifying wages capped at $10,000 per quarter for each of the first 2 2021 calendar quarters, right? That ends March 31st and June 30th. In 2020, the credit was capped at $5,000 per employee. And in 2021, the cap was $7,000 credit per employee per quarter, or $14,000 total for the first 2 quarters of 2021. The quarter-over-quarter gross receipts in 2020, when you're doing the calculation, had to prove a decline of 50% from 2020 to 2019 of revenues, used to help determine the eligibility to take the credit. And we're going to give you an example of one in 2021 in a few minutes. I just want you to understand the differences between 2020 and 2021 for this employee retention credit. And the quarter-over-quarter gross receipts decline had to be 20%, decline of 20%, at least 20%, from 2021 to 2019. or what is known as less than 80%, right? 20% decline. So you didn't have to show 50% decline. You can show a 20% decline. Now, in 2020, a large employer limit was up to 100 full-time employees. In 2021, the large employer limit is based on 500 full-time employees. And then in 2020, no governmental entities could qualify for the credit, but in 2021, colleges, universities, and certain other health-related governmental entities qualified. Okay, so let's look at the next slide. Then what happened? Under the Infrastructure Investment and Jobs Act, it amended Section 3134 of the Internal Revenue Code and enforced early termination on the fourth quarter for your employee retention credit. And that actually happened while you were in the middle of the fourth quarter. However, it retained the fourth quarter employee retention credit for those businesses that are considered recovery startup businesses. Okay? And when the IRS realized that Congress had changed the law regarding the fourth quarter for others, not recovery businesses, for others, the IRS's first guidance on this was primarily, we'll get back to you later on what do we do with if you already had applied for advance credits under the Form 7200. And so employers that had applied for the employee retention credit after September 30th, 2021, and now you're in the fourth quarter, may have already reduced their employment tax deposits in anticipation of claiming the employee retention credit for the fourth quarter of 2021. So these taxpayers have to monitor the IRS guidance. And I always say, keep an eye on Washington, right? Especially when you're a practitioner or a business owner, even an individual these days. Some taxpayers may have already submitted Form 7200 for the advance payment of the retention credit in the fourth quarter. If the Form 7200 has not been processed, the IRS will use the taxpayer's indication of whether it is a recovery startup business on the Form 7200 Part 1 Line H as part of their determination regarding whether the Form 7200 claiming the employee retention credit in the fourth quarter of 21 applies or should be accepted or rejected, or if an advance payment of the employee retention credit for the fourth quarter was already sent to the taxpayer that is no longer eligible to claim the employee retention credit for the fourth quarter of 21 because it is not a recovery startup business, that taxpayer will still include that advance payment on the appropriate line of its employee tax return, Form 941 Part 1 Line 13H, for the quarter. And in this case, the taxpayer may have a balance due when it files that tax return. All right, but I'm sure there's going to be additional guidance on this and you should be aware of it, but I just wanted you to understand what was going on here. Now, we gave you the provisions of all the differences between the 2020 Act with regards to the employee retention credit and then what happened in 2021 with the Appropriations Act. Well, it increased the various employers that are allowed to be on the list. So you see from this list, generally when it was passed, it was employers of any size engaged in a trade or business, paying wages in a quarter, calendar quarter, in which business operations fully or partially suspended due to a government order, and the business had a significant decline in gross receipts, and that was, as we said, 50%. In 2020, that included exempt orgs and excluded governmental entities. But then in 2021, the list was expanded to include tax exempts, college, universities, hospitals, and medical care providers, and then eventually governmental entities. Now, in a lot of this tax law legislation, you will see government order. Are you affected by a government order? And you need to know what that means. The order from the city, the mayor in your area requiring non-essential businesses to close. And why do I say non-essential? Because in each state, when the pandemic hit and there was a shutdown, there was an immediate list on the COVID-19 sites of each state saying which businesses are essential and which businesses are not. All right? So if you take an example of a repair shop, that business was considered essential, right? But if there was a shutdown on March 13th of 2020 and they are an essential business, but their customers are not coming because the customers were required to stay in home, they then have to approve their decline in 2020 by up to 50%, right? They had to have at least 50% of a decline in their receipts to get this employee retention credit. And then in 2021, they needed only to prove a 20% decline. But this slide 46 tells you what a government order is. It's either an order from city mayor requiring non-essential businesses to close, a state emergency proclamation that residents must shelter in place, other than those working for essential businesses that must travel to and from the workplace, order from local officials imposing curfew on residents that impact the operating hours of business, and order from local health department mandate workplace closure for cleaning and disinfecting. But remember, start with the COVID-19 list of essential and non-essential businesses on the state sites. So this compares the gross receipts test for the employee retention credit in 2020 under the CARES Act of 2020, and then under 2021 under the Appropriations Act. In 2020, you had to prove a decline of 50% or a government order stoppage of gross receipts comparing a 2020 calendar quarter to the same 2019 quarter for a controlled group. And a lot of this legislation talks about controlled group. I mean, you have common ownership. They have to encompass under that umbrella. Credit ends in quarter following quarter in which gross receipts reach 80%. What does that mean? Well, I'm qualifying because I'm 50% of the same period in 2019 when compared to 2020. I have a 50% decline. But the next quarter, my gross receipts reached 80% comparing a 2020 calendar quarter to the same 2019 quarter for the controlled group. Then I must immediately stop getting the employee retention credit in the next quarter. All right, that was 2020. In 2021, we had to only approve a decline of 20% of gross receipts for the controlled group and compare the 2021 calendar quarter to the same quarter in 2019, right? So we have to understand what gross receipts mean. Many times we read the legislation, but we don't think about what the words mean. So let's understand the definition of gross receipts. For a for-profit entity, that's your total sales less returns and allowances, plus you must add investment income, interest, dividends, rents, royalties, annuities, and then subtract out your adjusted basis and assets sold. In addition, you see added to this slide, rents, royalties, as we said, annuities, contributions, gifts, grants, and member dues. That's for your tax-exempt entity. Now, what if my business didn't work or wasn't in place all of 2019? Remember, the CARES Act was signed into law 14 days after the shutdown. So we're looking at 2019 as our benchmark. But what if my business wasn't in place all of 2019? So there's an alternative measurement period for employers commencing business in 2019. If a business started in the second, third, fourth quarter of 19 and used that quarter as the base period to determine whether it experienced a significant decline in gross receipts. If the employer commenced business in the middle of a quarter in 19, the employer should eliminate the gross receipts it would have had for the entire quarter based on the gross receipts for the portion of the quarter that the business was in operation. So there's an alternative calculation there, and you need to be aware of it, even if you don't understand how to do it. Startup recovery businesses, however, had to prove they're less than $1 million in gross receipts for the last 3 years. Well, you said, Doreen, it's a startup. What are you talking about? Well, I'm talking about that you could be a startup who purchased a previously established business during the pandemic. But you have to have non-related employees. You must have payrolls of at least one employee. The Infrastructure Investment and Jobs Act did not terminate the employee retention credit for the last quarter of 2021 for these businesses. So let's look at an example. How earnings here are less than 80% of the 2019 earnings for the same quarter, right? Or we have at least a 20% decline, okay? And we see when we compare 26,000, right, to 144,000, 18% of 2019 earnings, correct? We take 40,000 at the 2021 to 2019, 200,000, and a 20% of 2019 earnings. And we see that we're eligible in this scenario. So let's talk about what is the definition of qualified wages. Gross wages subject to Social Security taxes and allocable group health care benefits, including your HDHPs, your HRAs, your FSAs, we talked about flexible spending accounts, excluding your health savings accounts, HSAs, and the related QSEHRAs. All right. I summarize again here. In 2020, there was a 10,000 annual limit per employee for your employee retention credit. For employers with 100 or fewer full-time employees, and looked at all wages there. Other employer wages paid to individuals not rendering service, what is that? Healthcare expenses and retirement contributions. The credit rate of 50% of qualified wages and the maximum credit of $5,000 per employee. In 2021, expanded 10,000 per quarter limit per employee, employer with 500 or fewer full-time employees or wages. Other employers' wages paid to individuals not rendering services, again, add back of healthcare expenses and retirement contributions, and a credit rate of 70% of qualified wages, maximum credit of 28,000, but then the infrastructure bill took out the fourth quarter, so it was really a maximum credit for the year of 21,000. All right, we take that fourth quarter out, but not for the recovery businesses. So you can see it was expanded, and you see the legislation moving. So what you need to do in certain cases, you're going to do a amendment to a 941, especially in the first quarter of 2020, or if you have not applied the employee retention credit, and then you realize later you can apply the employee retention credit. But what you need to take in mind, what is qualified wages? You can allocate, as we said, if that employee was not working, health plan expenses and employer retirement plan contributions. But you have to make sure that the retirement plan document is amended. You can't just do this without amending your policies. For employees paid by the employer determined actuarially, by premiums paid, even by the COBRA costs. It excludes wages for which an FFCRA credit we talked about earlier, sick and paid family leave was claimed, and for 2021 if an R&D credit was claimed. And then of course for 2020, at the wage rate paid in 30 days immediately preceding suspension of operations or decline in gross receipts. So you look at the previous 30 days when the operations suspended to determine what the average rate is for wages. Now, how do we determine the number of full-time employees? A full-time employee is an employee who in 2019 averaged at least 30 hours of service. So that's not the same as calculated under the Affordable Care Act, which is 40 hours for a full-time equivalent. So you must know the legislation. The average number of full-time employees determined by taking the number of full-time equivalents in each calendar quarter in 2019 divided by 12 to find the average number of full-time employees. And then the special rule applies if the employer was not in business for all 2019 or started business in 20. And we talked about that. There's an alternative rule. But again, if you are a recovery business, last 3 years, your revenue was less than $1 million, and you did not exist in 19, you can use the alternative method of calculation, which would allow the employer to substitute 19 for 2020 for that same corresponding quarter. And also, you would be eligible for startup recovery for the third and fourth quarters of 2021, which is a maximum of $50,000 per quarter, right? But you have non-related payroll reports. Okay, so now let's look at the interaction of the employee retention credit and the PPP loan forgiveness. Wages cannot be used for both PPP loan forgiveness and the employee retention credit. That's pretty obvious. Forgiveness applications often include payroll costs and other expenses in excess of what is needed for loan forgiveness, so you have to watch out for that and make sure it doesn't affect your wage. Okay, here's a summary of the 2021 credit enhancements. You have PPP loan borrowers that can claim the credit in 2020 and 21, and public colleges, universities, public health care entities can now claim the credit in 2021. It has been extended through 2021, but then taken away by the infrastructure bill in the fourth quarter. And we show you the other comparisons between the two acts that we talked about before. But how do you claim the credit? Well, in 2020, obviously you had to immediately amend your 941 to claim the credit for the 2020 payroll returns. If you amend, you then have to track that amended 941 to your corporate returns, to your business returns, and then those would have to be amended. The credit for 2021 reduced the payroll tax deposits, which is federal income tax withheld from employees, Social Security, and Medicare taxes. They added that. In 2020, you couldn't do the Medicare. And then retroactively file Form 941-X for each quarter claimed, or if you wanted to do it in advance, file Form 7200, or if you were current and it was available on the Form 941, you could apply for it there. So this is an example of qualified wages. You have wages in first quarter for employee 1 and 2, equaling $10,000 each of $20,000, and then wages 2 in the second quarter, $10,000 each, equaling $20,000. No add back for health and plan expense, and a total of quarter 1 and 2, which is equal to $20,000 per employee, total $40,000. Under the American Rescue Plan, you're going to then apply a 70% calculation to your eligible wages to get the credit calculation, which is $14,000 per quarter here in quarters 1 and 2. And then remember, you have the third quarter, but not the fourth quarter in the case of anyone other than a recovery business. So look at your chat, start to get your chat ready to answer this poll question. Put your answer in the chat. To claim the ERC retroactively, an employer should file one Form 941-X for all prior quarters for which it is claiming the credit. Is that yes or a no? In other words, does the employee just file one Form 941-X for all quarters for which it is claiming the credit? Yes or no? And the answer is no. You have to file a 941 for each of the quarters where you're claiming the credit, 941-X, if you have an amendment there and didn't do it on the Form 7200. So the key word here is retroactively. The key word here is retroactively, which is a very, very strong word, right, in tax law. All right, slides 62 and 63 talk about accounting, not necessarily the tax side of it, which will be the third slide, but I wanted you to be aware of the accounting for loan forgiveness, right? So we know the PPP loan proceeds had to be used to cover payroll costs and most mortgage interest, rent, and utility cost over the 8 or 24-week period, depending on when you fell into that area. And the employee and compensation levels had to be maintained, right? And also depending on what forms you use, and that's definitely outside the scope of this. I did a whole presentation last July 2020 on that during the pandemic. The CARES Act explicitly provides the loans forgiven under the PPP are not subject to taxation as discharge of indebtedness, as they shall be excluded from gross income. Okay, so that's good, as I said, for the Small Business Reorganization Act if you're looking to file for bankruptcy, or other provisions with regards to applying for credits. Accordingly, additional taxable income should not result from the forgiveness of PPP debt. For state income tax purpose, it will vary, right? It will vary. So we look at accounting under section ASC 405-20, extinguishment of liabilities. and ASC 470-50, debt modifications and extinguishment. And Doreen, why are you bringing this into a tax presentation? Because believe it or not, your tax presentation is a lot of times based on your accounting presentation. More and more these days, they're getting married, so you need to understand. So ASC 405-20 provides accounting guidance relevant to the extinguishment of debt. ASC 405, when a debtor is legally released from a liability, the debt is considered extinguished via a legal defacence based on information available at the time, right? So generally, when debt is extinguished, the debtor will calculate a gain or loss on its extinguishment. The guidance indicates that that gain or loss is calculated as the difference between the reacquisition price of the debt and the net carrying amount of the extinguished debt. And that's what you have to put on as a gain or loss on your return. Not on your return, sorry, on your books. And then those will be M1 adjustments later on your return. And that's, again, a little bit more complicated. So the TQA on these, what do? Would you initially record the cash inflow from the PPP loan as a financial liability and accrue the interest in accordance with the interest method under that ASC 835-30 that's listed there. You would not impute additional interest at a market rate. You would continue to record the proceeds from the loan as a liability until either the loan is partially or wholly forgiven and the debtor has been legally released, or 2, the debtor pays off the loan. And then 4, would reduce the liability by the amount forgiven and record a gain extinguishment once the loan is partially or wholly forgiven and a legal release is received. And I gave you a link to this AICPA article on that. Additionally, Grant Thornton had an interpretation on the accounting for PPPs with regards to grants and U.S. gaps. And I'm going to, kind of let you read that on your own, because again, we're getting out of the taxable area into the accounting area. But what I do want you to understand on that slide is, if you go to the bottom, watch which method of accounting you're using for tax. Is it going to be cash or accrual? You are now permitted under the Tax Cuts and Jobs Act of 2017, with an adjustment for inflation, the business is permitted to use cash. Business average annual gross receipts were $26 million or less for the 3 previous years. You're allowed to use cash. However, if you are in your books and records, or you have an applicable financial statement, what is that? An audited financial statement by a CPA, a 10K if you're a public company, annual statement to shareholders, or a financial statement that you filed with a foreign government under International Financial Reporting Standards, IFRS, because a lot of us are doing work outside the country. The method of accounting from that AFR must be used. All right. So you said, okay, Doreen, I understand I have to do my books in one way, do my tax return in another, then reconcile it on the tax return, the difference between the 2 accounting methods for tax and for our books, depending on if we have an applicable financial statement. And that's where the Build Back Better was kind of zeroed in on, because they were looking at our net income from the book perspective, which is page 4 of your corporate returns, and your partnership returns might be next page or so, where you see, there's a difference. That's supposed to represent your books, okay? That's supposed to represent your books. So I can't emphasize enough, you must also look at your NAICS codes, the codes that define your business with regards to all these acts, okay? Because there was a second draw of Paycheck Protection loan money, as long as you got forgiveness on the first. And they said, well, you don't need to do that unless you have $150,000 less on a loan. But yes, all the banks were asking for the forgiveness first. They wanted to make sure you were forgiven. So what if we are forgiven under a PPP loan with a tax perspective? Well, the Appropriation Act provides a welcome relief to all businesses with PPP loans. So you'll recall under the CARES Act, it provided that amounts forgiven under the PPP were not treated as taxable income for federal income tax purposes. However, the CARES Act did not address whether the payroll and non-payroll costs that supported the PPPs were also deductible. And so we went through a number of months of this interpretation. Eventually, the PPP that was forgiven is not going to be taxable, and the expenses that we paid with the PPP funds were going to be deductible. Well, that helps the small business. What else came out? Well, for flow-throughs, S-corps, and partnerships, the IRS formally rescinded its earlier guidance. And it said that we will allow loan forgiveness increases to your tax basis, at least in the context of the pass-through entity, which is your partnership and S-corp, where taxes are paid generally on the individual level. The tax basis in the business doesn't increase until 2021, the year of forgiveness, while the PPP expenses are deductible in 2022. So what, in English, please, what is that? You're going to keep your liability on your books, unless you were forgiven, in 2020. Bring it over to 2021, and then once you're forgiven, you will then do your journal entry to increase the basis in your S or partnership, and then recognize a non-taxable event on your M1 schedule on your tax return. Now, in order to help restaurants throughout the pandemic, there was various legislation that was passed. And this was actually a good one, I thought, where a restaurant who had been affected through a shutdown or couldn't start their business in the recovery period were able to get a restaurant revitalization fund grant, okay? And you go through all the process. Remember, in all of these programs, you need to keep your records for 6 years, but also in this particular fund program, or grant as you would call it, if an entity cannot use all the grant funds or permanently cease operations on or before March 11, 2023, the entity must return the unused funds to the U.S. Department of Treasury. And I had a client who could not open up. They started in 19, they tried to open up, they were working, they were fixing the place, they were doing leasehold improvements and all that stuff to it. Then the pandemic comes, they couldn't open up. Finally, in 2021, this restaurant revitalization fund comes into place and they apply for it, get approved, and all that expense, up to $70,000 that they spent, they were able to get reimbursement for. But here's the clincher. They had to open up. So finally they did, but if they don't stay open until March 11, 2023, they have to return the unused funds to the U.S. Department of the Treasury. But I always tell people, check the... Okay, let's talk about the taxation of cryptocurrency and non-fungible tokens. Crypto transfers of $10,000 or more must be reported to the IRS, and that's under U.S. Department of the Treasury, what's known as the American Families Plan Tax Compliance Agenda, May 20th of 21 on page 21. The taxation of cryptos or NFTs, non-fungible tokens, is addressed in notice way back in 2014-21, considered an investment asset. So these are investment assets. That's where the IRS looks at them. But there's now more information on what's ordinary income versus capital gain. And so the next section on this slide, which is section 122, is it a capital gain? So if you purchase a cryptocurrency and you're holding it, but you didn't sell it and buy another cryptocurrency, you don't have a capital gain transaction. But if you're holding cryptocurrency and putting it in stablecoin, again, you're not having a transaction go back in. Once you transfer to another crypto, you're either going to have a short-term or a long-term gain. As we know, short-term is a year or less, and long-term is 1 year and 1 day or more. What I always like to do is look at the tax brackets, right? When do we apply the 0% bracket? Well, if I'm in the tax bracket of up to 12%, with the capital gain, I have a 0% capital gain rate. If I go into the 22%, 24%, then I'm in the 15% capital gain rate area. And then 35% or more, I'm in the 20% capital gain rate area. So we need to be aware of that. And also, I get a lot of questions on tax loss harvesting, meaning I have gains, I can dump some of those bad apples that I have in investments, but that's the client's suitability. As a practitioner, we have to watch when we tell them, yes, you could take advantage of losses, but if you have a large loss on a holding and you think it's going to come back, you could actually sell it and take the loss. However, you need to wait 30 days before you rebuy it, and there could be increases at that time, right? Because then you will be precluded of the loss, all right? Be precluded of the loss. Okay, what else do we know about crypto? It's estimated that 18 to 21 million taxpayers, as you see at the top of the slide, will need to consider a crypto transaction. We'll need to be aware of that in 2021 as we go through the 2022 tax season to prepare these crypto schedules. And of course, it's going to be a Schedule D, Form 8949, if it is a long or short-term transaction. But also, on the front of your return, you have a question that asks whether they received, sold, sent, exchanged, or otherwise acquired any financial interest in virtual currency. Now, during 2020, if I just purchased virtual currency with real currency and had no other virtual transactions, this is according to the National Taxpayer Advocate, I must answer no to that. That's a no. If your only transactions involve virtual currency during 2020 were purchases of virtual currency, you're not required to answer yes to the 1040 question. But as we said way back, the IRS put into place IRS Notice 2014-21, where we know that cryptos are investment assets, as long as we're not a market-to-market or a trader, right? Virtual currency traders can request market-to-market, meaning they would go on a Schedule C, and net operating losses are subject to the NOL rules and those schedules. Then in October of 2020, the draft new form instructions that anyone who sold cryptos, received airdrops, exchanged cryptos, or got services paid through crypto must report yes via the IRS letter 6173, 74, and 74A. What about FinCEN? You know, we all have FBAR situations where we have to talk to our clients, and on our Schedule Bs it asks for, do you have a foreign account? At any time during the year, did you have $10,000 in that account? Then you must file an FBAR. Now, when is a cryptocurrency considered a foreign account? When it is in an unhosted wallet, okay? That's when you have to file your FBAR. In addition, if you see in the middle of the slide, under these regulations, transactions involving counterparties with unhosted wallets or transactions involving counterparties with accounts in foreign jurisdiction that are high risk, right, for money laundering, and are subject to currency transaction reporting, what's known as CTRs. When transactions aggregate to greater than $10,000 per day, records alone must be kept if they aggregate to more than $3,000 per day. And in addition, your Form 8938, if this is in fact a foreign holding that you have, if it goes up to $150,000, you must attach that to your return Form 8938. And all of these pretty much are going to be in effect in 2023, all right? So the broker tracking of the crypto, that's going to implement in 2023. And then we see the Build Back Better looking at wash sale rules under IRC Section 1091. Now, the Joint Committee on Taxation estimated that these reporting requirements will help the IRS collect approximately $28 billion in additional federal income taxes, and that was reported under the Digital Assets in the Infrastructure Investment and Jobs Act that was passed in November of 2021. Now, we talked about current legislation. We talked about the pandemic. We talked about the Tax Cuts and Jobs Act of 2017 and how some of this legislation affects it. What we need to do is go back to the Secure Act, because many of us are, in essence, like financial advisors when we're speaking to our clients, although there's a whole other rules on that. But you need to be aware of this. So under the Secure Act, which was passed and effective for tax years beginning after December 31, 2019, we have to look at our RMDs. We have to look at what's the definition of compensation. We have to look at whether our retirement plans for our clients must be set up because they have part-time employees, especially if you're in the New York City area. And for certain taxable non-tuition fellowships and stipend payments, a good thing came out. They came out to be treated as compensation for IRAs. So now they can contribute to this through their IRAs under this term of compensation, including any amount that is included in the individual's gross income and paid to the individual to aid in the pursuit of graduate or postdoctoral study. Also was retained the qualified charitable deduction because, you know, it was very pro-charity. And at the end of the year, you want to be aware of that for your clients who are 70.5 and up. They can donate, do a qualified charitable deduction, donate to a qualified charity. If you go into irs.gov, publication 78, do a search. Up to $100,000. It doesn't hit their return. It goes directly to the charity. So your Social Security calculation doesn't get affected. The QCD, because it's a deduction, that are not includable in gross income, right, as we said, but just goes directly to the charity. If you have a new child, a new birth in 2021, or an adoption for a child under the age of 18, there's penalty-free withdrawals from retirement plans that those individuals could take and do it before December 31st without paying a 10% penalty. They're going to pay income tax, and then, of course, you have to calculate the state. Increase in age for RMDs from 70.5 to 72. So if in 2020 you hit 70.5, you do not have to take your RMDs until age 72. Now, I had a client who hit 70.5. In 2018, they were 70. 2019, they hit the, 2018, they hit the 70.5 mark. 2019, they were supposed to take their RMD, but they were able to defer it to 2020. In 2020, they had to take their RMD for 20 plus their deferred RMD, but because of the pandemic, it was suspended. And then in 2021, they were ready to take their 21 RMD, but then they passed away. So under the Secure Act, that beneficiary is one of the eligible beneficiaries. It was a sibling who was not more than 10 years younger, and they were able to apply for the deferred lifetime table, where the Secure Act was trying to get away with those stretches. So you have to look at each situation. Now, for 529s under the Secure Act, and this is a very important topic that you want your clients to look at before December 31st, 2021, Section 529 plans are expanded to cover the cost of fees, books, supplies, and equipment required for the designated beneficiary's participation in a registered apprenticeship program. Also, tax-free distributions are allowed from 529 plans to pay principal or interest on a qualified education loan. So that's another qualified distribution that, because of the pandemic, you can take advantage of, or your client can take advantage of. Modification of required distribution rules for designated beneficiaries if the account owner died in 2020. And it also depends on if they were in RMD mode or not. So these are your eligible designated beneficiaries under the Secure Act, effective 2020. An eligible designated beneficiary is an individual who, with respect to the employee or IRA owner on the date of his or her death, is the surviving spouse of the employee or IRA owner. That's still in place. A child of the employee or IRA owner who has not reached majority. A chronically ill individual as specified in Code Section 401A, 9E, Roman numeral 2-4, and any other individual who's not more than 10 years younger than the employee or IRA owner. Now, in the Secure Act, they say you have to take the first distribution after the year of death, which would be, if it was 2020, it would be 2021 or 2021, 2022. But they've increased the failure to file penalties in this area, so you have to watch out for this when you're working with the financial institution and your client. Also in the Secure Act, the kiddie tax provisions were affected and that were added by the Tax Cuts and Jobs Act of 2017. They mirrored it to estate and trust rates, but now in the Secure Act, it took that out and is back to personal income tax rates of the parents or of the child, depending on the amount of income we're talking. Okay, so this change affected children under age 19 as well as full-time students under age 24. This means the child will once again be taxed at the parents' rates on net unearned income if higher than the child's rates. Effective for tax years beginning after December 31st, 2019, but taxpayers can elect to apply retroactively, meaning we could go back to 2018 and 19 if we're still in the statute and amend those returns to apply the new act. And the reminder that any gifting rules per recipient is still at $15,000 for 2021, but will be $16,000 for 2020. So another great thing that was put into place was you could get a credit of up to $5,000 for startup costs. And eligible employees, again for 2020, may be able to claim a credit of that amount, up to that amount. Now it depends on how much expenses they have. You could look at the bottom of this slide of eligible expenses, where you can claim the credit for ordinary and necessary costs to set up and administer the plan and educate your employees about the plan. Of course, part-time workers now can contribute to their 401k plan, provided they work 500 hours or more for the employee within the required periods. Employers are not required to match in this situation. But when you do put this plan into place, which can be done, even if it's after December 31st, the profit sharing portion can be contributed, not the employee deferral portion, up to the filing of the tax return, which is March 15th of 2021 in this case. Now, the amount of the credit is 50% of your eligible startup costs up to the greater of 500 or the lesser of 250 multiplied the number of NHCEs who are eligible to participate in the plan, or $5,000. Again, that goes on the K1 of the pass-through. The eligible tax years is you can claim the credit for each of the first 3 years of the plan and may choose to start claiming the credit in the tax year before the tax year in which the plan becomes effective, meaning I told you could do the profit sharing portions, you could do it in 2022, but put the plan in place for 2021 as long as it's before the filing period deadline. You can't both deduct the startup cost and claim the credit for the same expenses. You aren't required to claim the allowable credit at that time. Auto enrollment tax credit. An eligible employer that adds an auto enrollment feature to their plan can claim a credit of $500 per year for a 3-year taxable period beginning with the first taxable year the employer includes the auto enrollment feature, so they want you to do that. Of course, it's great for the employee because you have a savers credit depending on if they are within the threshold caps, with a maximum credit of $2,000 for joint filers and $1,000 for others. And the Secure Act allowed all sized organizations known as a MEP, multiple employer plan, to join together and be part of the same plan and help to improve compliance. And even if there's a bad apple in the plan, it won't affect the other plan holders in that MEP. So payroll, in addition, with payroll matters, we were able to defer our Social Security tax in 2020 based on the passage of those 2020 acts. And in the CARES Act of 2020, it enacted a deferred payment of 2020 payroll taxes, allowing employees to defer payment on their 6.2 share of Social Security tax made from March 27, 2020 to December 31st, 2020. Not all employers did it because they were worried because if the employee left, they would be on the hook and all this other stuff. But this includes self-employed who are eligible to defer a portion of their self-employment tax as well. Now the letters are going out. And the letters are CP2567 for your self-employeds. They must pay 50% of that back before December 31st, 2022, and 50% before December 31st, 2021, which is now. So how do we do this? Any self-employed taxpayer who deferred a portion of their SE taxes to the 21 and 22 tax years must pay those taxes separately under the instructions found in Notice CP256V. Do not increase estimated tax payments. It's a separate payment. You use the voucher, or you could go on EFTPS for deferred Social Security tax. And there's updated information that you could go to at irs.gov/coronavirus. Businesses who deferred Social Security taxes which were affected on their quarterly filing of Form 941 received the notice CP256V for each quarter. Now, I just did one last night where we calculated where the deferral was. You have to put that quarter in 2020, and then you make the 50% payment now before December 31st, 2021. So we did it for December 29th, and then the next one for next year before December 31st, 2022. And that's, I just told you how to do that. That tells you about the stakeholder liaisons and the small business links that you can have there. Now, as I brought you back to the Secure Act of 2019, I want to bring you back to the Tax Cuts and Jobs Act of 2017. And in there is what's called the Qualified Business Income Deduction, where a business can take up to 20% of qualified business income, QBI, that is available for your sole proprietors and pass-through owners, S-corps, partnership, etc. For 21, the deduction is reduced when taxable income exceeds $164,900 for individuals or $329,800 for married couples filing joint, and is phased out completely when individual reaches the $214,900 or $429,800. One of the other things we have to look at is whether that business is a specified service trade or business, like an accounting firm, like a law firm, like a healthcare provider who doesn't sell goods or goods, they just sell services. They meet one-on-one with the patient. That is a specified service trade or business. And any rental property that they rent to themselves with regards to this through a pass-through is also considered an SSTB if they are 100% renting to themselves. If they go over these thresholds, they still could get the QBI deduction. Don't think they can't. But they have to take into account W-2 wages and unadjusted basis immediately after acquisition on their balance sheet to determine what the limitation is. And of course, that's why they need the practitioners. There are still QBI deduction benefits for rental real estate investors. Certain real estate interests qualify for the 20% pass-through income deduction. We thought at one time our two-family did, but really it's not, because you're not required to issue 1099s. So the key to this act is that whatever business you do take that QBI deduction, you need to be complying with your 1099 issuance policies. These enterprises are generally defined as owning real estate for purposes of generating rental income. And so in order to claim the deduction, you must keep separate books and records showing income and expenses for each rental real estate enterprise, complete 250 hours or more of rental services each year if your rental real estate enterprise is less than 4 years old. For older enterprises, 250 or more hours of rental services are performed in at least the last 3 of the past 5 years. And rental services include advertising property for rent, collecting rent, completing repairs and maintenance on the property. What it doesn't include is reviewing your financial reports or meeting with your accountant. And so they must maintain contemporaneous records, including time reports, logs, or similar documents for hours of all services performed, description of all services performed, dates on which such services were performed, and who performed the services. All right? And of course, with a timely filed return, you attach that safe harbor election for small taxpayers to get that 250-hour requirement in place, because then it will jump up to the specialty trade and business, which is 750 hours for rentals. So again, refresher. Pass-throughs are able to take this. It's the lower of the QBI income times 20% or the taxable income times that 20% threshold, the lower of. And C Corps cannot take this, but you can do it for your Schedule E's and your Schedule C's. So that was just a quick reminder of the QBI. And in Build Back Better, I don't see a limit to that, but I know eventually they would like to do that, so take advantage of it. This slide reminds you of a very near and dear topic that I have. Every summer, the IRS has a security summit, and they try to reach out to you to tell you about new schemes that are out there. The Security Summit partners continue to see instances where tax professionals, especially those who engage in remote transactions, have been vulnerable this year to identity thieves posing as potential clients. The criminals then track practitioners into opening emails and attachments that infect computer systems. You must have a written security plan in place and how to fight against identity theft, because you're the one holding the most confidential information that there is. So this is a slide you can read at your leisure. It talks about some of the scams that are out there and what the thieves are using. So it's slides 86 and 87, and I gave you some additional links to help you which is your publication 4557, Safeguarding Taxpayer Data, the Small Business Information Security Fundamentals, and the publication 5293, Data Security Resource Guide for Tax Professionals. And here, when you're writing your written security plan, because remember, when you're renewing your PTIN, you have until December 31st to do so for the upcoming tax season. You need to click whether you have a written security plan. So there are 10 key steps to protect sensitive information for your tax and office written security plan. 1, don't forget to use security software for computers, tablets, and mobile phones. Remember, I said you had to have an inventory of those items and who are using them and when are they using them, and keep it updated. Make sure antivirus software for computers has a feature to stop malware, and there's a firewall enabled on that, including your router. Phishing scams like imposter emails, calls, and text are the number way thieves steal personal information. Don't open links or attachments on suspicious emails. And this year, fraud schemes related to COVID-19 are the economic impact payments and other tax law changes are very common. Use strong and unique password, 10 or more. Use phrases or a series of words that can be easily remembered, or use a password manager. 5, use multiple factor authentication whenever possible. Many email providers and social media sites offer this feature, and it helps prevent thieves from easily hacking accounts. Shop at sites where the web address begins with HTTPS, which is for secure. And also look for the padlock icon on the browser window. 7, don't shop on unsecured public Wi-Fi's or open your phones there with client information and your information in places like a mall. Remember, thieves can eavesdrop. 8, at home secure home Wi-Fi is password protected and WP2, securely encrypted. With more homes connected to the web, secure systems become more important, from wireless printers, wireless door locks, to wireless thermometers. These can be access points to identity thieves. Backup files on computers and mobile phones. Know who's using those. And anyone who just terminated, eliminate their use right away. You can use a cloud service, but the information should be encrypted before it goes into the cloud. And also you can use a hard drive backup drive, but you must take it off premises regularly and replace it with a new drive. Working from home, consider creating a virtual private network to securely connect to your workplace. So those are the 10 top things you should have in your written security plan. With regards for international matters, very complicated topic, but just be aware your Schedule K1 is going to have a K2 and a K3, and these schedules will be used with Forms 1065, 1120S, and 8865 U.S. persons with respect to certain foreign. All right, let's move on to the next slide. I provide you a lot of resources in this presentation, and one of them is the IRS Audit Technique Guides, ATGs, and I'm wondering if anyone has read them. Please put that into the chat and tell me what guide you've read. But the IRS provides ATGs to help its examiners during audits. The ATGs provide useful information on issues and accounting methods in a specific industry regarding business practices, terminology, and income examinations. And here are some of the newly released guides. Retail industry was in March of 2021 that was released. Construction industry, April of 21. Non-qualified deferred compensation plan, a plan that is a non-qualified deferred compensation arrangement between an employer and an employee, in June of 21. Real estate property foreclosures and cancellation of debt in August 21. And activities, non-engagement for profit Internal Revenue Code 183, activities not engaged for profits, September of 2021, referring to your hobby loss rules. So here is on page 92, or slide 92, your glossary of terms. I want to emphasize, if you get nothing out of this presentation, keep good books and records. Small businesses and practitioners need to do the same. The IRS reminds individuals and businesses that special record-keeping rules apply to taxpayers claiming a charitable contribution and taking ordinary and necessary business expenses. You must have your receipt, support, backup ledgers, general ledgers, etc., and the specific forms. And again, you could go for COVID relief at irs.gov, coronavirus. And so the next few slides are just form changes, and you could read those at your ledger. For example, 8812, 461, 2441, 7202, 8962 that we went over. Line changes on your Form 1040, we talked about the new charitable standard deduction. Line for earned income credit expanded. Line 27B for non-taxable combat pay election, and line 27C added for prior year 2019 earned income. And also amended filers need a lot of patience this year. As of November 13th, the IRS had a backlog of 2.7 million unprocessed Form 1040Xs. Normally, it can take IRS up to 16 weeks to process an amended return. Now, the wait time is considerably longer than 20 weeks, according to the IRS's National Taxpayer Advocate. And so here are some changes to your Schedule 1, Form 1040, additional income and adjustments to income online for everything and everything on online. You have here removed college tuition deduction for Taxpayer Certainty Relief Act due to expansion of the education credits that I previously talked about. On your Schedule 2 now, there's a line for unreported Social Security and Medicare tax expanded, and the Form 8812 additional tax credit. And Schedule 3, Form 1040, for your non-refundable credits expanded, and new products that are out there. The Form 8453 TE tax exempt entity declaration and signature for electronic filing. That was under the Taxpayer First Act of 2019 and replaces Form 8453-EO, which has been retired. Exempt organizations will be exempt entities. That's what they'll be known as. Form 8879 TE, IRS e-file signature authorization for a tax exempt entity, TFA, replaced Form 8879-EO, which has been retired. And delays in IRS's practitioner priority line service. I had gotten a call, I think Lenny had mentioned to me at one point that he was having trouble getting into, and all of us, through the practitioner priority line. So they upped their transcript services where you could get up to 30 transcripts. You must have a 2848 power of attorney on file or 8821 tax information authorization on file for that and be part of the e-services. Again, publication 4557, Safeguarding Taxpayer Data, a guide for businesses, has been updated. Your Form 941Xs with regards to all the legislation we talked about. Form 943, Employer's Annual Federal Tax Return for Agricultural Employees, and 940 instructions, as well as 941X have been updated. And we talked about the international K1, which is your K2 and K3, and there's hefty penalties with those, as well as Schedule C Form 1116 foreign tax determinations. So these are your resources. Here are your links. Here's some additional resources with regards to the COVID-19 tax credit for employers who keep workers on payroll. And now I want to quickly go over the Build Back Better for what you should be aware of. First of all, the SALT, they're looking to increase from 10,000 to 80,000, and it may be retroactive back to 2021, go to through 2030, and then sunset and go back to the 10,000 and 231. It looks like it will, the Build Back Better will keep the TCJA estate changes into sunset to 2025, creating new surcharges on those that make 5 million, 10 million of income or more. Extend the American Rescue Plan Act's child tax credit through 2022. Extend the ARPA's temporary expansion of earned income tax credit. Limit individual retirement account contributions when balances reach 10 million, where they're going to want you to take out 50% each year until it gets to the limit that they are allowing. A net investment income tax on pass-throughs, even though you're not passive. Expand the base of the 3.8% net investment income tax. NIIT to apply to active business income for pass-through firms over 4,000 if single, 500,000 if married, filing joint, and over 13,000 for non-grantor trusts and estates, and make permanent the active pass-through limitation enacted in the 2017 Tax Cuts and Jobs Act. For the corporate issues, impose a 15% minimum tax on that net book income that I talked about for tax years beginning after December 31st, 2022. 23 is the year, and I think with the expansion of the audit area in the Build Back Better, we should take these presentations more as an audit tactic, right? How are we going to be ready for these audits? Creating a 1% tax for excise on ESOPs for repurchases after December 31st, 2021, and change the global intangible low tax income GILTI regime in 2023. The bottom of this slide, I think, is applicable to us. Extend or make permanent certain ARPA, American Rescue Plan, expansions of that premium tax credit, as well as make tax changes to target cryptocurrency, including imposing rules on related common control. My name is Doreen and Sarah. This is our Q&A session. If you have any questions, let me know. Of course, this is my interpretation of the codes. You need to do your own research, but you're welcome to retain my firm's services to do more extensive research. These are the codes in the back of your presentation with regards to the code course numbers if you are a CPA in New York State looking for CPA, or if you are a IRS registered preparer, enrolled agent, or other type of practitioner that is registered. This is IRC course code section here, and what's up and coming in January. Thank you for having me. Let's go to the Q&A. So always with Doreen and Sarah, you could relax and learn some events coming up before and after the upcoming tax season. Which trust is it? Spring Zoom webinar. I'm going to talk about the types of trusts, especially understanding what is a grantor trust versus a complex trust, and possibly audit tactics in developing your tax office written security plan, which would be on demand. Revised Circular 230 update ethical practice, ethical guidance in tax practice, and that would be coming later after in the spring.